Players in the economic sector have expressed dissatisfaction in the manner in which tax incentives and exemptions are offered to companies that invest in Uganda, citing abuse of the whole system with no transparent process and procedure for managing and granting it. Civil society organizations and economic analysts cite loss of revenue in billions of money every year, averaging to 5% of current revenue base, with allegation that a number of beneficiaries are footloose companies that close shop at the end of each tax holiday and reopen under different names.
Who gives exemptions? How are they given? What's the role of the minister in granting them? What's the role of parliament in granting them? So that as a country all know why company X is given exemptions and not company Y. What benefits arise from giving company X exemptions, as opposed to company Y?
In a dialogue organized by the Southern and Eastern Africa Trade Information and Negotiations Institute, CEATINI, analysts argue that the system has no transparent mechanism to gauge who is exempted from what and for how long, resulting into market distortion and unhealthy competition. To civil society activists, tax incentives agenda was copied from developed countries like Malaysia and Mauritius with no idea of how to implement it.
So what civil society wants now is to understand why the tax incentives, why to that particular company, to that person, and how they have benefited.
Incentives in Uganda are offered under 6 categories that include exemptions under the Investment Code Act of 1991 that is given to companies that can utilize local raw materials and foreign exchange and offer employment. Incentives under Income Tax Act of 1997 that takes into account sectors like agriculture, tourism, mining, education, among others. Exemptions under the Value Added Tax Act of 1996 that exempts tax on raw materials, plants, machinery, drugs, ambulances, and scholastic materials. Investors are also free not to pay tax under the East African Community Customs Management Act of 2005, where goods imported for re-exportation to partner states are exempted from import duty, and exemptions under the East African Excise Management Act.
The mode of tax incentive that, for example, that was given to BIDICO is very wrong, because that was a grant. You give free land and you give an corporate tax. So what are they paying at the end of the day? They have destroyed the environment, they have got free land, they have got free financing.
Government is on a campaign trail that aims at changing Uganda into an industrialized nation by the year 2040, and part of its mechanism is to offer tax holidays to companies, majority having got the leverage, especially in manufacturing and hotel sector. But up to date, questions arise as how the incentives are given and what economic value it has brought to Ugandans. Kenneth Bwire, WBS News.